Yeah, in my opinion, debt service coverage ratio is even more important than loan to value or loan to cost, especially when you're talking about permanent financing, which looks at in place income. So your debt service coverage ratio is the relationship between your net operating income
Mhm.
divided by amortizing debt service payment. So you take, revenue minus expenses, that's your net operating income. And then you divide that by the debt service for the loan, assuming you're paying principal and interest. And
Mhm.
that's something that trips people up sometimes because technically speaking, even if the loan is an interest only loan where you're only paying interest payments every month, the debt service coverage ratio is still calculated based on a interest and principal payment.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very special guest, my good friend Rob Beardsley, with me. Welcome to the Real Estate Vibe Show, Rob.
Thanks for having me.
A little bit about Rob. Rob oversees acquisitions and capital markets for Lone Star Capital and has acquired over 350 million in multifamily properties. He has evaluated thousands of opportunities using proprietary underwriting models and published the number one book on multifamily underwriting, The Definite Guide to Underwriting Multifamily Acquisitions. Actually, Rob has published another book last year, Structuring and Raising Debt and Equity for Real Estate. And we'll talk about that today. Rob, this is the second time on our show, right, Rob? Your
Yes.
last show was, I looked up episode number 39, where we talk about your success journey from football to real estate. So if anybody like to tune into that, please go ahead and do that. Once again, the last episode number is 39, where Rob took us through his journey from football to real estate, a success story. So today we'll discuss structuring and raising debt and equity for real estate. Rob, would you please briefly remind me about your background? How did you become who you are today, from your football to real estate success story, a little bit?
Yeah, absolutely. So I grew up in Silicon Valley. My family my parents ran a residential brokerage firm from home. So I was exposed to real estate early on, but I didn't really latch on to their business or real estate in general. What I did latch on to, as you alluded to, was football. Football was a major part of my life. And I think I learned a lot of great life lessons from being a part of a team and learning responsibility, accountability, hard work, and sacrifice. And I, my dream was to get recruited to go play football at an Ivy League school like Harvard, for example, would have been a dream. Unfortunately, I didn't get recruited to one of the Ivy Leagues, but I got recruited to play football at Carnegie Mellon. And that's how I landed in Pittsburgh at Carnegie Mellon studying computer science and information systems. And once I got to college, I realized, well, if I'm not going to go pro at football, I don't think it's really the best idea for me to commit 20 hours plus a week to
Mhm.
something that's really not going to have that much lasting benefit. So at that point in time, I felt that my purpose in football had run its course and I quit. It was a big decision, but it was a great pivot to the next phase of my life. And at that point in time, I started focusing on business and how to make money and being really curious about that. And that's where I discovered real estate, which was, in college, and was really lucky to join a mentorship program, meet my business partner, actually start the firm Lone Star Capital while in college, and then drop out after the second year. And from there, we were, off to the races, building up the business.
Wow. And how long ago was that?
That was a little over 5 years ago now.
Wow. And you guys been just growing exponentially since then, which is awesome.
Yeah, I would say growing at a good pace, not too fast. Sometimes it feels a little slow even, but all in all, we've had great success over time. And I think what's great about this business of investing in real estate is it's a long-term business. It's not going to go away tomorrow. And
Mhm.
everything that we're working on today and building is just going to compound over time.
That's true. So you wrote your new book. So I have the book actually right in front of me. Structuring and Raising Debt and Equity for Real Estate. So I read the book. I was pretty impressed by that. So I thought we wanted to discuss that in this episode so we can share some insight with our listeners on debt and equity. So in your experience, how do you approach the process of structuring debt and equity to a fund, a real estate project?
Yeah. So my preference is to keep things as simple as possible. Once you start becoming more educated and advanced in structures and products, there's the inclination to make things more complicated and to over engineer and whatnot. And I think while that can work and it is fun, the simpler capital structure is often the best. And so, especially when we're talking about investors, uh, we want to keep things as simple and straightforward as possible for our investors rather than trying to overcomplicate things for just a little bit higher return, right? We want to make sure that our investors can sleep at night and get a great return. So with that, especially these days with where the capital markets are, and we can talk more about that, I think it really just makes the most sense to focus on agency debt, which comes from Fannie Mae and Freddie Mac, and particularly at a fixed rate. There's a lot of controversy, if you will, surrounding floating rates versus fixed rates today. And we are focusing all of our efforts on fixed rate financing right now because while maybe interest rates come down in the next couple of years, and if we floated, we'd benefit from that, it's just not worth it to have to deal with that monthly headache and risk. So that's kind of our focus right now, is being able to sleep well at night, which limits us, right? Because there's a lot of deals out there that we just simply can't buy because we're not willing to underwrite the deal using different structures like a bridge loan product or preferred equity and things like that. So it's forcing us to kind of keep things simple and buy more straightforward, less risky deals.
You said keep things simple. So let's start very simple. Let's understand what debt is to begin with, in a simplistic way to explain it. How would you explain what is debt and what are the different type of debts that we use in the multifamily investments?
Yeah. So, in our business, debt is a first lien mortgage that the lender has the right to be paid first and to be paid back first upon a sale or a refinance or anything like that. But the magic of debt is positive leverage. So when you're able to buy a property that produces a 5% cap rate, which is 5% unlevered cash flow, and let's say you're able to lever that with 4% debt, that will, because your cap rate of 5% is greater than your debt at 4%, that'll actually boost up your cash on cash returns up to 7-8% or something like that. So, and that's magical, right? So debt can be magic when it works well. However, there's also such a thing as negative leverage, right? And so today we see a lot of negative leverage, and we frankly have seen negative leverage for the last handful of years as the market's gotten more competitive, where today cap rates might be at a 5, but your financing costs are 5.5%. And so when you have negative leverage, that's going to take your unlevered cash flow of 5% and knock it down to 4%. All right. So on a cash flow basis, that's a pretty straightforward relationship. And that is a big way that debt affects your deals.
So since you're talking about the negative leverage, what are some of the primary considerations for a multifamily investor when deciding on debt financing or the loan type? Because there's multiple loan products out there. So if you can touch on that.
Right. So speaking of different products, we had touched on, fixed rate loans versus floating rate loans. We also have short-term loans versus long-term loans. And generally speaking, if you're floating, that's a higher risk than fixed. And if you have a short-term loan, it's higher risk than a long-term loan, because the idea is if your loan matures sooner, you're going to have to be forced to either sell or refinance that loan in a shorter period of time. And it might not be the right time for that to happen, right? Because if your loan matures right in the middle of a recession, that could be a problem. But if you have a 10-year loan, the likelihood of being caught at the wrong place, wrong time in 10 years from now goes down, as opposed to a 2-year loan or a 3-year loan. So time horizon is a big factor. And today we're financing mostly at 7 years because for us, 7 year term we think is a sweet spot where it's long enough to be considered long-term debt, but it's not the full 10 years where we might be stuck and locked into a loan for a long time. Which brings me to a very important point that is often overlooked by many investors, which is the prepayment penalty. And prepayment penalties are huge because they can really impact the returns of your deal. For example, yield maintenance is a very expensive prepayment penalty clause, which basically entitles the lender a portion of the full loan term's interest. So if you lock in a 10-year loan, that might be great, but you need to analyze the downside of that, which is if you have a fixed interest rate for 10 years, you're going to have a very expensive prepayment penalty to go along with that. And if you, for example, want to sell after 3 years of ownership, there's going to be 7 years worth of yield maintenance that you're going to have to deal with. So that's something that we definitely are concerned about and want to make sure that we feel comfortable taking on prepayment penalties. And that, frankly, is one of the beauties of floating rate debt or short-term debt because the prepayment penalties are very modest, 1% or even no penalty. So that gives you ultimate flexibility.
But the thing is, then you're taking more risk, right, with the floating rate and the shorter term loan, you might be paying more interest. At the same time, I just think out loudly over here that when you're deciding on a loan product going shorter term or longer term, shouldn't that at that time, shouldn't your business plan should be considered? Like what your business plan is for your property. Are you going to stay in the property for 5 years, 3 years, 7 years? And accordingly, you should decide on the loan product or the length of loan. Otherwise, if you get a 10-year and then you're paying the prepayment penalty, or you're keeping the loan unnecessarily for the longer term, and which have more implications regarding that.
Yes, that's exactly right. That's a great point. Your business plan should very much so tie in with your debt choice. So if you're the type of investor that wants to be in and out and only hold for a couple of years, then a 10-year loan would not be the right choice.
Mm-hmm.
And also in a different example, if you have a property that is well occupied, well performing, and there aren't really any renovations to do, then they would be most likely a mistake to use a bridge loan for that acquisition because there really isn't much of a transitional business plan involved that would warrant the bridge loan, right? So matching the business plan to the debt is a very important thing to do to make sure that risk is under control and that you are optimizing for what you want, right? Because different investors want different things. Some investors prefer cash flow and they're not worried about the sale being so soon. And then other investors, they don't care about cash flow. They just want their money back and a profit as quickly as possible.
So are there any specific loan products that's specifically designed for multifamily investors only? Or are there any difference between these long-term or short-term loans for multifamilies?
Well, there's definitely some unique products out there, and multifamily, I would say, is the most fortunate of the commercial real estate asset classes when it comes to debt, because we have access to Fannie Mae, Freddie Mac, and HUD financing. And so, meanwhile, bad things are happening in office, retail, hospitality potentially, and because those loans are commercial mortgage-backed securities based, so CMBS, or they're bank loans. As we've seen in the news, right? Banks, regional banks have come under pressure. The credit markets aren't doing so well, which the CMBS markets rely on. So while there's economic uncertainties and maybe issues in the market, Fannie Mae and Freddie Mac are federally backed loan programs, which provide tremendous amount of stability and the best terms in the market for those loan products. So when this is especially helpful in harder times, because in good times, right, banks can give you the money, debt funds can give you the money, hedge funds can give you the money. You can get money from everybody in good times. But in bad times, everybody clamps up and it's very important to have access to capital. And so that's where Fannie Mae and Freddie Mac, as government-sponsored enterprises, really shine.
Interesting. So what are some of the key factors that lenders consider while they're underwriting your property? whatever you're considering to get the loan against, especially in today's market, since everything is so squeezed and the capital markets are really kind of not in a really good shape. And overall, there's so much market volatility. So what are they looking for? And how do you handle all, since you recently have one loan, I think you worked on one or a couple. So what was your experience like, if you can share that?
Yeah. So it breaks up into two categories
Mm-hmm.
because loans, like we talked about, there can be long-term loans and short-term loans, and specifically bridge loans.
Mm-hmm.
And bridge loans are underwritten differently than long-term debt. And so we can focus on long-term debt first.
Mm-hmm.
So with long-term debt, the lender is going to be very much so focused on the in-place performance of the property because they're making a loan based on today's income, and then that's going to be good for the next 5, 7, or 10 years.
Mm-hmm.
So they don't really care that much about what your business plan is because they're making a loan based on today's numbers. So if you show up and say, well, I'm going to raise rents and I'm going to reduce expenses, they'll say, well, that's all great, but there's only so much they can do with the in-place numbers, right? There is some tweaks they can make with the expense adjustments and things like that. If you can present an argument that, okay, well, the current owner has higher expenses, we can operate it at a lower expense, and they'll go along with that. But on revenue, especially, it's very rigid, and they're limited as to what they can underwrite. So lenders, in that case, looking at the in-place income of the property to determine the size of the loan that the property can manage.
Mm-hmm.
And on a bridge loan scenario, it's very different. The lender now is much more like a partner with you, and they're looking at your business plan and they're looking at your pro forma, and your pro forma is your projections for the financials in the future.
Mm-hmm.
So the lender is going to take into consideration your renovation budget, your business plan, and your pro forma in order to decide what loan they can give you today.
Mm-hmm.
And that's a great thing, and it's a very good strategy, but it's inherently riskier because the lender isn't making you a loan based on today's income. They're making you a loan based on tomorrow's income. So that's why it's riskier, because if tomorrow's income doesn't materialize, you're going to have some problems.
That's true. And then bridge is just like a bridge, like the way it sounds, bridge is a bridge going from here to the Fannie Mae or Freddie Mac loan, right? A permanent loan, I would say this is a bridge, like a gap that they're trying to bridge for 3 years or 5 years, 3 years plus extension. That could be 5 years.
Right.
That could be interest only, right? That's the way I look at it. So in this scenario, two scenario you gave us, like the agency loan versus bridge loan. So as a borrower, do I have a choice? Which route should I take? Or is it like I'm pretty much on lender's mercy, whatever I'm going to get, and accordingly I tweak my plan and work with that?
Yeah, as a borrower, you mostly have the choice unless the property is underperforming. Because if the property itself is not a stabilized asset, then a lender is going to have a harder time putting a permanent loan on the property because it's not a stable property to begin with. And that's where a bridge loan comes in to stabilize the property and bridge it to, like you said, permanent financing. So with that being said, there was a lot of people that took advantage of the very strong debt terms out there from bridge lenders in the last few years, which it's changed now for the last year, but for a couple of years before that, bridge loan terms were so attractive that even on stabilized properties that were 95% occupied, people would choose to use a bridge loan because it was just cheaper and they could get more leverage. So you often do have the option, but again, it goes back to marrying the business plan to your loan product.
That's true. I like that, actually, marrying your business plan to your loan product, because the way I see it, if you wanted to give the property only 3 to 5 years, even the 90% occupancy or 90 plus percent occupancy, and if you're going to stay on the property for only for 5 years, doesn't make sense to go to the longer term loan, right? So bridge might work for a lot of people. I think that's the reason people were opting in. So there's, I think in the when you're getting the loan, there's a few terminologies that we use, like loan to cost, loan to value. So like LTC or LTV, how does that impact your financing and feasibility of your project?
Yeah, so loan to cost and loan to value are two ways to evaluate the loan amount or the size of the loan relative to the value of the investment. And so value and cost can be very similar, but typically when people say LTV or loan to value, they're specifically referring to value as the purchase price, right? So if I'm buying a $10 million property and I have a $7 million loan, that would be a 70% LTV or loan to purchase price. Now, if, for example, that $10 million acquisition, if I had also budgeted a $2 million renovation budget, now I could base my leverage ratio not based on just the purchase price, but I could base it on the total 12 million, the 10 million purchase price plus the 2 million renovation budget. And that will actually inform me more clearly as to the leverage level. Because as real estate investors, we don't just spend money on renovations to make the property look nicer, right? We do that because we want to get at minimum a dollar for dollar increase in property value, which means if I invest $2 million in renovating the property, at minimum, I should see $2 million in increased property value, but ideally more, right? So if I'm evaluating my leverage and I say, okay, well, let's say it's $8 million of leverage on a $10 million purchase, say, well, that's 80% leverage. That's kind of high. But if I have a $2 million renovation budget and I evaluate it on a loan to cost basis, that would be 8 million divided by 12 million, which is now 75% loan to cost. So you might think, okay, well, 75% loan to cost, I'm more comfortable with that. That seems okay. So it's loan to cost is more informative pretty much in all circumstances. But with that being said, for permanent loans, people more so think about loan to value because they're lending on the in-place value. And then for bridge loans, people think more about loan to cost because the lender is loaning based on the future and the business plan.
So what is the rule of thumb from the leverage perspective? Is it more leverage good or the less leverage is good? Because obviously you feel more comfortable as an investor when there is less leverage, right? When you have, but at the same time, you're raising equity too. That's the next topic we're going to talk about. So if you can shed some light on that, on the leverage perspective, which is better?
Yeah, leverage is great in that it magnifies outcomes. So if you have a good outcome, leverage will make that an even better outcome. However, if you have a bad outcome, it'll make it even worse. So leverage is a tool that needs to be used carefully. And I would say general rule of thumb in today's market, I mean, the reality is the numbers are so tight on an in-place financial basis that if you're looking at agency debt, maximum you're looking at maybe 65% loan to value, which is somewhere around 55 to maybe 60% loan to cost. So agency loans are maxing out at a pretty low leverage level anyway. So I would say if you're going agency or permanent debt, basically just however much the lender is willing to give is still an okay loan amount for the most part, right? And then on the bridge loan side is where things can get a little riskier and lenders can offer you more debt than the property really should probably take. And that also goes back to the business plan and things like that. A year ago, people were doing a lot of bridge loans at 80% loan to cost, which is high leverage. And I don't think very many deals are getting done at that leverage level today. Things are a little bit more back down, maybe 75, maybe 70% loan to cost. So today we feel good. I would say anywhere between, too low of leverage is not a good thing. And that's something that we're running into. We're running into the problem that the lender's only willing to give us, 53% leverage. Well, that's a problem because now we're going to have to bring in way too much equity on the deal. And the deal might be a good deal, but the equity returns aren't going to be attractive enough for our investors because there's simply not enough debt involved in the deal to leverage up those returns. So I would say too low of leverage is bad. And of course, too high is bad. So for us, the sweet spot today seems like around, 65% loan to cost. That would be great. Maybe even 70 on the high end.
Interesting. And there's another acronym that we use in the real estate industry, or say in the debt service, called DSCR, debt service coverage ratio. What is that? And how does that impact the overall loan structure?
Yeah, in my opinion, debt service coverage ratio is even more important than loan to value or loan to cost, especially when you're talking about permanent financing, which looks at in-place income. So your debt service coverage ratio is the relationship between your net operating income divided by the amortizing debt service payment. So you take, revenue minus expenses, that's your net operating income. And then you divide that by the debt service for the loan, assuming you're paying principal and interest. And that's something that trips people up sometimes because technically speaking, even if the loan is an interest only loan where you're only paying interest payments every month, the debt service coverage ratio is still calculated based on a interest and principal payment. So with that in mind, kind of the industry standard is a 1.25 debt service coverage ratio, which simply means that your net operating income is 125% of your amortized debt service. And that is people in the industry consider that to be a healthy cushion so that your income has plenty of margin to pay your debt expense and not get you into trouble. So, even if your NOI goes down by 20%, you're still able to cover your debt. And that's a good position to be in because that means that your break-even occupancy is probably somewhere down in the 70s and even lower if it's an interest-only payment. Because if you're only paying interest and don't have to pay principal, then that will boost up that relationship between NOI and debt service even more.
Yes, and plus that you have some wiggle room, right? If you're going 1.25%, because after paying the interest, you still have some margin left that you can, use or distribute to investors or whatever. So here I'm going to ask you about Fannie Mae and Freddie Mac. We were talking about the agency loans earlier, the government-backed loans available for the multifamily investments. So I wanted to ask you, what are some of the benefits that you see with these loans? Sometimes they take longer time to close, right? And as an investor, I might not have that much time. So I might want to opt in for bridge loan or any other product out there versus Fannie Mae or Freddie Mac. But I wanted to understand from you, because you have kind of in-depth understanding of all these loans and you have done a bunch of fun. So what is your take on that? What are some of the benefits with Fannie Mae and Freddie Mac or the agency loan overall?
Yeah, I would say the biggest factors are pricing. The interest rate is usually the best. And so, things change, and that's what makes this business so exciting is there's always things changing. But generally speaking, the terms and between the interest rate, the interest only terms are usually the most favorable. So that I would say is the most compelling part about Fannie Mae and Freddie Mac. And as far as timeline, it usually doesn't take that much longer than some of the other loan products out there. Of course, if you need a quick close, then you need a quick close. You're going to need to find that specialty lender that can close in, whether it be 5 days, 2 weeks, or 30 days, whatever it is in your case. But we usually find that we close, we want to get more organized and get faster. But I feel like once we sign up the debt, I feel like it takes about 45 to 60 days for us to close, which, for us, we're not complaining. Would we want to close faster? Yes. But between handling all the legal and preparing the asset management stuff and raising the capital on the equity side, we like that time anyway. So we're not really struggling with that. However, HUD has very attractive debt, but that can take 3, 6, even 9 months. So we've never done a HUD loan before, primarily due to that reason. But that is an interesting offer where, okay, you can get this really attractive debt, but you might have to wait 6 months.
So that might be good for the construction of a new project or a development project, right? Because you can work with the timeline a little bit longer on that side. So let me ask you one more thing on the Fannie Mae and Freddie Mac, the agency loan. You were talking about the yield maintenance earlier, or kind of waterfall structure that it could have, kind of step down, I would say, for the interest perspective or the prepayment penalty. But these loans are assumable as well in nature, right? So the next buyer can come in and they have the option to assume the loan at the current interest rate. If you want to talk about that, that might save you the prepayment penalty or the waterfall or the step down, whatever you call that approach right there.
Right. Yeah, that's definitely another agency superpower, right? Fannie Mae and Freddie Mac loans are assumable, which we take for granted, but the reality is not all loans are assumable in that way. And so that can be a more efficient way to sell a property or to buy one, right? If you approach a seller and they have an existing Fannie Mae or Freddie Mac loan that's attractive, it might make sense to assume it rather than originating a new one, right? So that's something to consider. And like you said, when you sell and you have the buyer assume your existing loan rather than paying it off, that could save you a lot of money on prepayment penalties. So that's an analysis that you need to run. Is it better to sell free and clear? Is it better to sell on assumption? Similarly, another superpower are supplemental loans. So instead of refinancing the loan and paying penalties and closing costs and origination fees on the new loan, you can simply go back to Fannie Mae and Freddie Mac, show them the progress you've made and the value, additional value created at the property, and you can get a supplemental loan, which would be similar to a refi, and that will provide more debt on the asset, which, if it's accretive or if it's positively levered, will increase the cash on cash returns while being able to distribute money back to investors, essentially like a cash out refi.
Great. Let me add one more thing into this in the loan structure. So this loan called non-recourse loan and recourse loan. So we can talk about the difference between the two and which is most commonly used, non-recourse or recourse.
Yeah, I believe in our business of kind of institutional multifamily, non-recourse is much more common than recourse.
Mm-hmm.
You know, there's a few number one rules of real estate, and one of those is never sign recourse, right? And the other one is location, location, location.
Mm-hmm.
And there's some other number one rules, but that never sign recourse is a very important thing to consider because recourse really is a big deal. And what recourse means is the loan isn't collateralized by just the property itself. It's also protected by the personal guarantee of the loan signers. So if I'm buying a property and I have to sign the loan and it's recourse, then I'm personally guaranteeing that loan, which means that if the property goes south, the lender may have the opportunity to pursue my personal assets in order to receive full repayment. So that's not preferable, right? You would prefer the loan to be non-recourse, which means that the lender can only utilize the collateral or the property itself to pay back themselves in a downside scenario, and they're not able to pursue my other assets.
So thanks for sharing your insight on the recourse and non-recourse. I know everybody likes to get the non-recourse loan, but sometimes for some other development projects, especially the construction, those are the recourse loans. And then you're on the line. But that's another advantage of that is that the investors who are investing with you, they feel more comfortable even. They trust in your project because you are on the line because you're getting a recourse loan. So I wanted to also ask you here, even though we are out of time, but one last question regarding the debt. What are some of the common challenges that the investors face when they're trying to secure these loans that you have experienced and you can share with my viewers?
Yeah, certainly when starting out, the biggest challenge I think are the borrower qualifications. So a lender is looking to make a loan typically to someone who has a net worth equal to or greater to the loan balance, as well as 10% in liquidity relative to the loan amount, and then also have experience in owning and operating a similar asset. So if you're starting out, it's, how do you have that experience, right? It's kind of chicken or the egg. How do I get a loan if I don't have the experience? And how can I get the experience if I don't get the loan? So those qualifications can be tricky to satisfy, which is why it's so important to treat real estate like a team sport and bring people onto your team that are able to satisfy those requirements to the extent that you're not able to. So that's a mistake that we made. We kind of didn't think about building those relationships and building the right team to be able to handle those issues. But of course, we eventually learned and we put it together. And then thankfully, we've built up the business enough to the point where our experience and our balance sheets are able to handle the lender qualifications on our own. So that's a great journey where, you start out and you need people to help you and you need loan guarantors, and then you over time graduate to being able to do it yourself.
That's quite an insight. Thank you for sharing that knowledge with me. I'm sorry we are out of time today, but can you quickly share how people can reach out to you?
Yeah, sure. Absolutely. So you can get in touch with me and learn more about Lone Star Capital on our website. It's lscre.com. On our website, you can fill out the contact form and you can download some of the free resources that we have, including our underwriting model tool that we use to analyze multifamily properties every day.
Thank you so much, Rob. I really enjoyed the show with you, but definitely I'm going to have you back. Let's talk about equity because we only covered debt today. So I'll see you back soon. Have a good one. Thanks again for being on the show.